What if I told you that right now, at this very moment, some of the biggest banks on earth are quietly trapped inside a trade they can easily escape? Not because of a crash, not because of a war, but because of silver and gold, two assets most people think are boring, old-fashioned, and irrelevant. Yet behind closed doors, something unusual is building. Vault inventories are shrinking. Paper claims are multiplying, physical demand is rising, and short positions, massive bets against precious metals, are piling up like drywood before a fire. Here's the mystery. If gold and silver are relics, as the financial media often claims, why are central banks buying record amounts of gold? Why are mints struggling to keep up with physical silver demand? And why are large banks holding some of the biggest short positions in history today? We're going to uncover how the silver and gold short squeeze began, why banks didn't expect this pressure, and how the system quietly set itself up for a potential shock. And by the end of this video, you'll understand why this isn't just about metals. It's about power, money creation, and who controls the financial system. Let's begin at the root. To understand what's happening now, we need to go back, not years, but decades. Gold and silver used to be money, real money, not paper promises, not digital numbers on screens, but physical assets that couldn't be printed at will. Then governments changed the rules. When currencies were detached from gold backing, something powerful happened. Central banks gained the ability to create money almost without limit. This allowed governments to finance wars, bailouts, and massive spending, but it also created a hidden problem. The value of paper money slowly eroded. Gold and silver didn't disappear. Instead, they were pushed into the background, turned into commodities rather than monetary anchors. At the same time, Wall Street introduced paper trading systems, futures contracts, derivatives, and synthetic products tied to precious metals. Now here's the critical detail most people miss. For every ounce of physical silver or gold sitting in a vault, there can be dozens, sometimes hundreds, of paper claims trading on exchanges. That means the market price you see isn't determined by physical supply and demand alone. It's heavily influenced by paper leverage. This is where short selling enters the story. Short selling is simple in theory. You borrow an asset, sell it, hope the price drops, buy it back cheaper, return it, pocket the difference. In precious metals, large banks and institutions have historically used short positions to manage risk, hedge mining production, and provide liquidity. But over time, something changed. Short positions grew massive, concentrated, dominated by a handful of large players. Instead of hedging small exposures, banks began using enormous paper positions that dwarfed the physical supply available for delivery. Why? Because as long as physical demand stayed quiet and investors preferred stocks and bonds, paper metals trading worked smoothly. But this structure had a weakness. It depended on confidence in paper promises. As long as most traders never asked for real metal delivery, the system stayed balanced. But history shows that systems built on leverage always face pressure points, and the pressure started building slowly, almost invisibly, after the 2008 financial crisis. Something fundamental shifted in global finance. Central banks flooded markets with newly created money. Interest rates dropped near zero, debt exploded, asset prices inflated. For years, this created the illusion of stability. But underneath the surface, trust in fiat currencies began weakening. People started noticing. Savings lost purchasing power. Housing became unaffordable. Food and energy prices climbed. At the same time, geopolitical tensions increased. Trade wars, sanctions, currency weaponization, and global instability pushed nations to rethink reserves. Central banks quietly started buying gold, not for speculation, but for protection. Meanwhile, retail investors rediscovered silver and gold as inflation hedges. Coin shortages appeared. Premiums over spot prices increased. Physical delivery delays became common. This was the first sign of strain, but the real problem came from supply constraints. Mining output didn't grow fast enough. Environmental regulations slowed production. Energy costs increased mining expenses. And silver, unlike gold, is heavily used in industrial applications like solar panels, electronics, and electric vehicles. So demand rose, supply tightened, and short positions remained large. This created the early stages of a squeeze setup. As physical demand accelerated, something strange happened. The paper price of silver and gold often lagged behind real-world scarcity signals. Why? Because short sellers could still flood futures markets with paper supply, suppressing price movement even as physical inventories declined. But this tactic has limits. When too many people want physical delivery at the same time, exchanges must either source metal or cash settle contracts. And here's where banks started facing a dangerous imbalance. They were short massive paper volumes in a market where physical availability was tightening. At the same time, inflation remained elevated globally. Interest rates rose, debt servicing costs exploded, governments continued printing money through stimulus and deficit spending. This created a paradox. Higher rates should support stronger currencies, but rising debt makes currency stability fragile. Gold and silver thrive in this environment. More investors moved into metals as insurance. More institutions diversified reserves. More individuals lost trust in fiat systems. Each new buyer quietly increased pressure on the short side of the market, like steam building inside a sealed container. And the container wasn't designed for sustained stress. There were clues everywhere, but few paid attention. Exchange inventories began trending downward. Delivery demand spikes appeared during contract settlement periods. Premiums between physical and paper prices widened. Silver shortages were reported across retail markets. These weren't random events, they were symptoms of structural strain. But mainstream financial media continued focusing on stock rallies, tech hype, and crypto volatility. Precious metals were treated as background noise. Meanwhile, banks continued holding short exposure, assuming the system would behave as it always had. This assumption may turn out to be the biggest mistake, because leverage works both ways. Just as paper selling can suppress price, forced short covering can accelerate it violently, and once momentum shifts, control becomes difficult. Right now, the system stands at a critical threshold. Physical demand is rising, paper leverage remains high. Global debt levels are unsustainable, currency trust is weakening. This combination has created conditions where even a small shock, geopolitical escalation, banking stress, or supply disruption could trigger rapid repricing. And when that happens, short sellers won't exit calmly. They'll rush, they'll compete for limited liquidity, they'll drive prices higher as they scramble to cover positions. Now we arrive at the most dangerous phase. Because history shows us something uncomfortable. Financial systems don't usually collapse slowly, they hold together until they don't. And when the pressure finally breaks, the reaction is sudden, violent, and irreversible. This is where the short squeeze scenario in silver and gold becomes more than theory. Let's move into the breaking point. A short squeeze doesn't start with headlines. It starts with liquidity stress. Here's how it typically unfolds. 1. Physical buyers demand delivery instead of cash settlement. 2. Exchange inventories tighten further. 3. Spot prices rise faster than expected. 4. Margin requirements increase. 5. Short sellers face losses. 6. Forced covering begins. Once this chain reaction starts, control becomes difficult. For banks holding large short positions, rising prices mean increasing margin calls. If prices spike too quickly, they're forced to either post more collateral or close positions by buying contracts back. But here's the trap. When multiple large players try to buy at the same time in a tight market, prices explode upward. This is not speculation. We've seen this dynamic repeatedly in other asset classes. What makes precious metals unique is their dual role. They are both commodities and monetary hedges. So when confidence in currencies weakens, demand doesn't just come from traders. It comes from central banks, long-term investors, and individuals seeking protection. This creates a rare condition. Rising demand meets shrinking supply while short sellers rush to exit. That's the perfect storm. If silver and gold prices rise rapidly due to forced short covering, the impact will extend far beyond metals markets. First, we see volatility spikes, large daily price moves, sudden repricing, increased market attention. Then the ripple effects begin. 1. Pressure on banks and institutions. Banks exposed to large short positions face balance sheet stress. Losses don't just affect trading desks, they affect capital reserves. This can trigger risk reduction across portfolios. That means selling other assets to cover losses, stocks, bonds, and derivatives become collateral sources. The squeeze doesn't stay isolated. 2. Currency. Confidence weakens further when gold and silver rise sharply. Markets interpret this as a signal. Trust in fiat currency is declining. This creates a feedback loop. Higher metal prices gives lower currency confidence gives more demand for metals. 3. Physical market premium explosion during high demand periods. Paper spot prices often disconnect from real-world physical prices. Premiums on coins and bars increase. Delivery wait times grow longer. This exposes the difference between owning metal on paper and holding it physically. And once that awareness spreads, demand accelerates again. When financial stress rises, institutions don't sit still, they intervene. Historically, several tactics appear again and again. 1. Margin requirement hikes. Exchanges can raise margin requirements to slow trading and force participants to reduce leverage. This can temporarily reduce volatility, but it also forces weaker short sellers to exit faster, which can ironically increase upward pressure. 2. Cash settlement incentives instead of delivering physical metal. Exchanges may encourage or require cash settlement. This avoids immediate inventory shortages, but damages trust. Once traders realize delivery is uncertain, demand for physical metal outside exchanges increases. 3. Verbal intervention and media narratives. Authorities and financial media often attempt to calm markets by framing price spikes as speculative bubbles. But words lose power when people see rising inflation, currency devaluation, and real-world scarcity. 4. Liquidity injection. Central banks may inject liquidity into markets to stabilize banks. But here's the contradiction. More liquidity means more money creation, which historically supports higher precious metal prices, so the fix can worsen the long-term problem. This isn't the first time precious metals markets have faced structural stress. History doesn't repeat exactly, but it rhymes. 1970s inflation era. During the 1970s, inflation surged. Currencies weakened, and gold prices rose dramatically. What triggered it? Was shocks, debt expansion, loose monetary policy. Sound familiar? 2008 financial crisis. When banks collapsed and markets froze, gold demand surged as trust in financial institutions collapsed. This time, the scale is even larger. Global debt is significantly higher. Derivatives exposure is massive. Central banks hold unprecedented balance sheets. The system is more interconnected and more fragile. Recent silver retail surges. In recent years, retail investor movements showed how quickly silver demand can overwhelm supply chains. Mints temporarily ran out of inventory. Premiums spiked. Delivery delays became normal. That happened without institutional panic. Now imagine the effect. If institutional short covering begins simultaneously, this story isn't really about silver and gold. It's about trust. The modern financial system runs on belief. Belief in currencies, belief in banks, belief in government stability. Precious metals act as a mirror. When confidence weakens, they reflect it immediately. That's why central banks accumulate gold quietly. That's why long-term investors diversify into hard assets. That's why physical demand keeps returning during crises. And that's why a short squeeze in metals isn't just a market event. It's a signal that leverage has gone too far, that paper claims have exceeded reality, that the system is correcting imbalance. Let's distill this into 3 powerful lessons. When markets rely on paper claims far exceeding physical supply, they become unstable. Short squeezes aren't accidents, they're structural consequences. In times of inflation, currency devaluation, and geopolitical risk, tangible assets regain importance. This pattern repeats throughout history. Calm markets don't mean healthy systems. Often, they simply mean pressure hasn't been released yet. Here's the uncomfortable question. What happens when too many people realize that paper promises aren't guaranteed? At the same time, if silver and gold experience a true short squeeze, it won't just reshape commodity markets. It will expose cracks in the global financial system, not overnight collapse, not instant chaos, but a slow shift of trust away from institutions and toward real assets. And once that shift starts, it's very hard to reverse. If this video helped you understand what's happening beneath the surface of the financial system, make sure to like this video. It tells the algorithm this content matters. Subscribe to the channel if you want more deep breakdowns on money, inflation, banking systems, and hidden market dynamics. And comment below. Do you think the silver and gold short squeeze will happen quietly or violently? Your perspective helps shape future content. Because in a world built on paper money, understanding real value has never been more important.